What's going on, everybody? Are you looking to learn how to day trade options? I mean, do you know what options are? Have you ever heard of an option contract before? I'm sure you've probably seen multiple people on whether that be StockTwits or Twitter or Instagram or YouTube talk about trading options and how you just make all these, fat bankrolls of cash. Now, before you start to get excited about options and can you do it and should you do it, I want to tell you a little bit of things that you need to also take into account before you actually start trading options. And that's what this video is going to be about. So the first thing is that you need to understand what an options contract is. So there's a lot of free resources and articles that you can go look at. Are you looking to just buy and sell the contracts, meaning you're looking to scalp, day trade, potentially swing trade them? Or are you looking to actually buy an options contract with the intention of actually executing those options and redeeming the shares for the option stock price? Now, for me personally, I am a day trader as well as a scalper. So for me, um, I'm never going to execute these options, meaning that I'm never going to, let's say Apple is trading at $100. I'm never going to buy an options contract for Apple at 95. And let's say Apple is trading over $95 and go ahead and execute that option to be able to buy the shares at 95. That's not really my game plan. That's not what I'm doing. I'm not looking to, build a bunch of shares and portfolios and stuff like that. I'm just strictly a day trader. So I'm going to be buying and selling these options contracts. Now, one options contract is equivalent to 100 shares of that particular stock, and you're going to be paying a premium to quote unquote have the ability to execute that option if you do, please, if it is in the money. So going forward, I'm going to assume that you're looking to day trade and or scalp options contracts. There's a couple of things that I really want you to kind of do your due diligence on and really understand before you start trading options. So if I could just bring up the word pad here, one of those first things that you're going to need to understand is, are you going to buy in the money contracts, at the money contracts, out of the money contracts? Okay, I'm going to kind of give you the differences between the three. So for example, let's say the Apple stock price is trading at $100. Okay, now an in the money contract would be something like buying an Apple contract for $98.50. That would be your strike price, meaning that this contract is already in the money. So if you are looking to day trade or scalp this, and let's say whatever particular strategy that you're playing, let's say Apple stock price goes to $101. Now that contract would be in the money, the 98.50 plus the $1 move from your entry. This contract would already start to move in your favor really, really fast. I know this is just a very basic and generic way to explain it, but I just want to give a brief overview for people who, might not understand the difference between what is in the money, what is considered in the money, what's considered at the money, and what is considered out of the money. So let's say, for example, an at the money contract would be something that is $100 to, let's say, 101. This is literally just at the money. Being the Apple stock price is trading at $100, the at the money contract would be anywhere from 100 to 101. It normally is going to be the contract that is just right outside of the strike price. And if we talk about buying something out of the money, maybe you buy a contract that expires in, let's say, 3 months. You're looking to swing trade this stock. And let's say you think and believe that the stock is going to go to $110. You can definitely buy a strike with $110 attached to that strike, and this would be considered out of the money. Now, what are the differences between in the money, at the money, and out of the money? When it comes to scalping, you definitely want to play at the money, in the money, okay? Now, you can most definitely play out of the money, but here's the problem what happens. So again, just using Apple stock at $100, let's say, for example, you take a particular play, you buy one contract, Apple's currently trading at $100, and let's say you buy a $110 strike, okay? And let's say Apple falls $3, okay? That options premium is going to significantly fall than, let's say, buying something in the money. Now, the difference between an at the money, in the money, out of the money contract. And why do some people play out of the money? Is because an out of the money contract is going to be very, very cheap. Okay. There's no intrinsic value there in that contract. If the stock is currently trading at $100 and you're looking to buy something at 110, the amount of dollars that the stock is going to need to move before it becomes in the money is a lot. So that options premium is going to be very, very cheap. So yes, you might take on less risk, right? For example, you're going to take on less risk if that, let's say that one Apple contract that's $10 out of the money is, let's say, trading for 25 cents, which is $25. So that contract is trading at $25 versus an in the money or at the money contract is trading for, let's say, $80 to $100. So you might be thinking to yourself, well, why would I spend $80 to $100 on an in the money at the money contract if I can buy something that's $25? Well, because if that the price of the stock moves up $1 or $2, those in the money and out and at the money contracts are going to move extremely fast in your favor. So you might get those contracts to move 20, 30, 40%, depending on how much the stock moves. Let's say the contract costed you $100. Potentially you would be making 20, 30, $40 on that one options contract versus if you did buy an out of the money contract and let's say you get that same $2 to $3 move on Apple, that contract might go from say $25 to maybe $35. So there's a big difference in level of risk. If you're new and you're just starting to, work your strategy, then hey, maybe you just want to practice your strategy buying a strike price that's, let's say, 2 or 3 strike prices outside of the money, low risk, buy one contract. If it moves in your favor 20, 30%, sell the contract. If the trade fails on you and your strategy breaks down for that one particular trade and you're forced to cut the trade, you don't really lose that much money versus buying something that's in the money or at the money where you could potentially lose 30, 40, 50% on those contracts. Now, the only one other thing that I do want to emphasize, if you are starting out and you are day trading or scalping weekly options expirations, meaning that the contract is going to expire same week as, let's say you do buy an out of the money contract or even in the money contract, and let's say the stock price drops, that contract could essentially expire worthless, meaning that you could essentially lose all of the premium that you put in. It's not like buying a stock. Let's say you buy one Apple share at $100 and the stock price goes down $3 at the end of the week. Well, now you just own one share of Apple that is now worth $97 versus if you bought one contract at the money and let's say it cost you $100 and the stock price dropped $3, now that contract can essentially expire worthless on Friday. So you could potentially lose that whole investment. So just want to make sure you understand that before going in and actually starting to trade options. Very, very beginner video just to kind of give you a brief overview. If you do like this type of content and you are serious about trading options and you want to learn more, do me one favor, subscribe to my channel. I'm going to be doing a whole series on strategies, how-tos, what you should do and what you shouldn't do, stocks that you maybe potentially should trade and stocks that you potentially should maybe stay away from. How long should you hold the stock? How long should you how long should you hold a play before it goes against you and just take your loss on it? So much information that I have to share with you guys. Again, just want to kind of give you guys a brief overview. If you are interested in day trading options, definitely want to learn those things first. What is an options contract? Do I play in the money, at the money, or out of the money? I would always recommend, if you have a plan to day trade and or scalp, I would definitely stay to as close to the money as possible. Meaning that if the stock price is $100, I would definitely be playing that strike price that is one inside, say 98, 99, or 97.50, something like that. Or I would be playing something that's, let's say, 100 or $101 strikes. Definitely, I would not be looking to play 10 options contracts that are out of the money. The current stock price is being traded at 100 and I'm going to go buy 10 contracts at 110. If I'm looking to only hold this for one day, I'm looking to only scalp this maybe for 5 to 30 minutes. So you're going to just get more bang for your buck. And if the stock does go against you, you're going to be able to cut it a lot faster without actually losing the rest of that premium. I hope this video kind of gives you just a little bit of insight on what options trading are. Again, like I said, please do me a favor, stick around on my channel, subscribe, join my Discord. That link is down in the description box below, and I will see you guys all in the next video.